What's up, family? This is your boy Ivan Hall, the Credit King. Have you ever wondered which credit scores do mortgage lenders use? Lenders will often request all three of your credit reports, one from each credit agency, and a FICO score based on each report when you apply for a mortgage. Due to rules imposed by government-backed mortgage firms Fannie Mae and Freddie Mac, the sort of FICO scores they want is frequently outdated versions. When you're looking to buy a house, it's crucial to understand the various FICO score variation. For each credit bureau, Experian, TransUnion, and Equifax, FICO developed various scoring models. The following are the most regularly utilized FICO scores in mortgage lending. Experian/Fair Isaac Risk Model V2 or FICO Score 2. Equifax Beacon 5 or FICO Score 5. TransUnion FICO Risk Score 04, or FICO Score 4. Mortgage lenders frequently get a single report that includes your credit reports from all three credit agencies, as well as your FICO scores. It may make a financing choice based on your middle credit score or the lower middle score if you're applying jointly with a partner. If you're searching for a mortgage that has a minimum credit score of 580, one of these FICO score models may require your middle score to be at least 580. However, there are several exceptions. For loans that aren't secured or acquired by Fannie Mae or Freddie Mac, lenders may utilize various credit assessment methodologies. Even if you have no credit history or score, you might be able to secure a mortgage. In addition, a study is underway that might allow multiple credit scoring algorithms to be used for mortgages, even whether they are secured or purchased by Fannie Mae or Freddie Mac. Many mortgage lenders will continue to utilize these three basic FICO scores until something changes. Your credit ratings might affect your ability to secure a mortgage and the interest rates you're given. When analyzing a potential borrower's application, mortgage lenders look at more than just your credit score. They'll look at all of the information in your credit reports, not just your credit scores. If you recently filed for bankruptcy or had your house foreclosed on, the lender may decline your application, even if you have a strong credit score. Or if you owe collection agencies too much money. Various financial information, such as current bank accounts, investment account statements, tax returns, and pay stubs, may be requested by mortgage lenders. They may use them to figure out your income, debts, and debt-to-income ratio, which is a crucial consideration. Other criteria, such as the loan size, the location of the house, your down payment, and the kind of loan, can all influence whether you will be accepted in the conditions of your mortgage. Lenders may do their own analyses, which is why searching for a mortgage is vital. The 300 to 850 range is the same for the FICO score versions utilized in mortgage financing and the more recently published versions, such as FICO Score 9 and 10. Vantage Score, a rival credit score provider, utilizes the same range for its Vantage Score 3.0 and 4.0 model credit ratings. A higher score is preferable for all of these scoring models that employ information from one of your credit reports to generate your score. As a consequence, you may see that your scores are trending in the same direction. This is why paying on time may help you boost all of your credit ratings, but skipping payments can lower all of them. There are, however, variances in the scoring models. The current FICO and Vantage score models, for example, overlook paid collection accounts and give medical collection accounts less weight. However, collection accounts are still counted against you in earlier FICO score models after you pay off the sum. Whether you're trying to purchase a house or take out a different sort of credit, there are a few things you can do to boost your overall credit score. Make timely payments on your invoices. Reduce your credit card debt. In the months leading up to your mortgage application, don't apply for any other sorts of credit. In addition to preparing your credit for a mortgage application, you need to also organize your money. Increasing your salary, saving for a higher down payment, and paying off debts can all help you qualify for a mortgage with better conditions. Get your finances in order and go get that money.